The stock market crashed in 1987, in 2001, and in 2008. With all this talk about a recession being around the corner, when is the next stock market crash going to be? Because if you know that, you can not only save yourself a lot of money by getting out at the top before the crash, but you can also make a huge amount of money by shorting it at the right time, reversing your train of direction for these markets from bullish to bearish, write it down, use all that cash to load up at the bottom again, and then get even richer when the next bull market comes around. So in this video, I'm going to share with you a simple trick that you can use to help you determine when the next market crash is coming, and you can use this in real time. I will break it down for you. Super simple. I'll show you how this worked in the 2001 crash and the 2008 crash, and how you can apply it to the current price action of the markets to help you find that next crash. So starting out here with the S&P 500, the SPX, this is a weekly chart. In blue we have the 50 simple moving average, and in red we have the 200 simple moving average. You can see new all-time highs for the SPX this week. It's just been ripping higher and higher and higher, which is crazy to see, but we're in this basically, I would say, a parabolic phase of the market, a melt up, the extreme bullish part of this trend. And you can see here, let's keep things simple, let's keep things technical, and let's keep things factual. Okay, my own opinion doesn't matter. It's not about my own bias. It's really about what are the charts telling us, what is the market structure telling us, and what are we looking for. So you can see, going back all the way to 1994 here, we had the crash of 2000 here, 2001. We had the crash of 2008 over here. And since the bottom, since the lows in early 2009, we have been in an up-only market where the SPX has gone from, I think the low was actually 666, and we're approaching almost a 10x in the nominal value of the SPX since those lows. It's been pretty wild, and we have not dropped below the 200 week moving average since we reclaimed it back here in 2010, with an exception of a bit of a wick in March 2020 with the black swan. But you can see here how when the markets are in a high time frame bullish trend, you can see the 200 moving average is just the support for the whole way up. And once it gets even above the 50, that's super bullish. Okay, so above the 200 is just a bull trend. Above the 50 and the 200 is just super bullish. So what we see is when we lose the 50, it tends to drop to the 200, and in the bullish trend that holds a support. That has been the case pretty much all the way here. You can see it lost the 50, dropped to the 200. Okay, even here we lost the 50, it wicked below the 200. This was March 2020, black swan, different story. But here we lost the 50, support held at 200, got back above it, and we're just running way higher. So the simple technical analysis here is that as long as we are above the 200 moving average, we are still in a bullish trend. As long as we're above the 200 and the 50, which is currently the case, we are just full-blown bullish. You don't get more bullish than that. Then we also know that when we lose the 50-week moving average, as we've done here, as we've done here, as we've done here, as we've done here, then most likely the next target for support becomes the 200. So at this point in time, you can see the 50 is about 5,120. So if we were to lose this 50-week moving average, then the next target becomes the 200-week moving average, which is around 4430 at this point. Now, what we can also deduce from this chart simply is that we only get our crashes, like the confirmation of the crashes really, once we get a death cross here on the weekly. And of course that's a little bit late when it actually starts, but you can see the bulk of the move down. Once we get that death cross, we have several months at least, probably a year before we recover again. So that's also good to know. So you know that once it finally gets to the point where we do get a death cross on the weekly, we're probably looking at least a year before we recover again maybe longer. So these are all things that you can simply just deduce from the charts, from the technicals, without needing to know the news, the interest rates, the macroeconomics. None of that stuff matters. It's purely the charts. So now let me bring to you also the concept of market structure. Market structure basically means that a bullish trend means making higher highs, like every time it's making higher highs, and higher lows. That's the definition of a bullish trend. And a bearish trend is, of course, the opposite. It is when we're making lower highs and lower lows. That's simply bearish and bullish trends, by definition, very, very easy. Now, how you can also spot a reversal is when we get a market structure break. So you can see this is constantly making higher lows, as you can see, higher highs and higher lows. But the moment that it makes a lower low, so you can argue that at this point we made a lower low. Where the green arrow is now, I'm putting it here, this is a lower low. So you can see all this time we're higher low, higher low, higher low, and at this point the market dropped below this low and it made a lower low, and you can see it went all the way back down to here and then it came up for a rally. So at this point where we broke the bullish market structure, we now have a lower low and we get a snapback. That tends to happen, but as you can see over here, we had that snapback rally, but it stopped. The low here became the resistance, right? So at this point, when it fails here, we have market structure break, a retest, a failure at the previous low. That is where it becomes dangerous. And sure, it's not the absolute top. You can see the top here was about 1500 and this level is about 1300. But being able to identify this area as the potential area where it makes a lower high and starts continuation of the bearish trend, even if you would have only gotten out of the markets here or maybe shorted it, it's still a 40% drop to the downside that you could have saved yourself. The same concept just works over and over. So I want to share this with you so that you can use it yourself to help you make better decisions. So we have a similar situation here for the 2007 crash. We are making higher lows. As you can see, each low is at a higher level, higher highs. So this is a clear bullish trend. Okay, and keep in mind this is a weekly chart, so this takes literally years to develop. So we have another higher low, another higher low, another higher low over here, and then we break it. Okay, so at this point we have the market structure break right about over here, and you can see after that pullback finished, we made a lower low over here. We got the snapback in the same way. We got the snapback here, and it went a little bit higher than its previous low, but not much. Not much. Actually, you can see there's a little gap there that it filled and then it rejected. So right at this point, once again, we can say that this area is a potential rejection for much lower. And again, if you would have gotten in even just somewhere over here, that could have been an almost 50% drop from that point. So this is how you can use market structure to help you identify when we are about to change the direction of the market for the longer term. Keep in mind, this is a weekly chart, so these things take months or years to play out. And it's obviously easy to do this in hindsight when you know what's going to happen. But it is possible that when you understand these concepts, that you can apply this in real time and that it can help you make better decisions of when to take profits, or when to short the market, or what to expect next. So let's apply this to the current in real-time situation to help us identify what's going on. Now, as you can clearly see, we have higher lows here all the time. Okay, the market is trending bullish. That's very obvious. We're making higher highs over here, and it just keeps going until it doesn't. At some point, the market's always correct, right? So after the bullish trend is done, we are going to get a pullback or a crash or a longer bearish trend. Okay, so at this point in time, we can say now that the previous low is over here. That is currently at about $3,585. So now we know that if for whatever reason we start to go back below, that would be a market structure break and would potentially set us up for a change in direction. Then we probably get a snapback, and if it fails over here, then we can maybe expect something like that. And this would be the level to watch. So if we break below it, it pulls back up, watch for that as the resistance for a higher low for it to come back down. But of course, in the meantime, as long as we're making higher lows, there's no reason that it can't just continue, keep going higher and keep making higher lows until that same concept. You just keep moving this level up every time it makes a higher low, and that becomes your target or your area of interest to watch for a market structure break. That's the trend reversal can go down. And this way you can help yourself by taking profits potentially, or by hedging, or by shorting and getting out of the markets and avoiding a massive potential 30, 40, 50% drop and drawdown in your overall portfolio. Now let's take a look at the dollar index, because this is very, very important, because there's basically just some sort of inverse correlation between the dollar index and risk assets. And this is especially evident in crypto, but it does seem that a lot of risk assets across different asset classes, whether it's stocks, gold, crypto, altogether, is they just behave in a similar way, that when the dollar index is trending lower, the risk assets trend higher, and vice versa. And you can see this very clearly when I overlay the crypto bull market cycles. So you can see here, I've clearly marked this, that at this peak over here at the beginning of 2017, the dollar index started a year-long downtrend. This is the weekly chart, the 50 simple moving average here in blue. And you can see this entire downtrend in the dollar index is when we had our first crypto bull market cycle. Then when it bottomed and the dollar index started going up for almost 2 years, we had our entire 2018 and 2019 bear market in crypto. Then in 2020, again, this peaked here at March 2020 during the Black Swan, and it started another year-long downtrend, and that is when we had our whole year-long crypto bull market, our previous cycle. Then we had our entire bear market when this bottomed here in May 2021. That is in fact actually when most altcoins also peaked, in May of 2021. I know Bitcoin had a slightly higher high, and there were a few other coins in November, but basically this went on a massive bullish trend, and you can see that lasted until the end of 2022. And when did our bear market bottom? At the end of 2022. So it is very, very clear with crypto, there's an almost direct inverse correlation, and a similar thing with stocks. So what we can deduce from that is that we want the dollar index to trend lower on the higher time frame. On this weekly time frame, we want it to continue lower, and we want it to continue to break down so that our risk assets can continue to pump, so that our stocks, our gold, and our crypto especially can go into bull markets and continue much higher. So what's also important to note is that the trend tends to accelerate once we break below the 50-week moving average. And that's the later stages of the bull market, when things pump the most. Over here also, you can see from June 2020 onwards, boom. So what's been interesting here is that we've had a lot of chop basically since beginning of January 2023. So for the last 2 years, we've been in this kind of chop where it's gone up and down, but nothing too crazy. For now, we are below the 50-week moving average, and we are trending lower. And as you can clearly see, there is this level of support here where we've been at for the last 2 years. If the price can break down below this now, I think we see a massive melt up in the stock markets, in gold, maybe even further, and in cryptocurrencies, most importantly. So if we are going to see a continuation down, whatever it might be, something like this, and we see a breakdown like that, however long it might last, this is going to give us a massive pump in crypto. This is going to give our parabolic blow off top, and maybe this happens quickly. Maybe the elections cause something that this breaks down below the 100 level and targets the 90 level. Maybe we target these lows. That would be perfect if we can do that, and maybe just head below there a little bit. bottom around over here at some point, and they're going to start a reversal. Well, obviously that's going to be the time to sell all of your crypto in the same way that it was at the bottom over there and that it was at the bottom over here. So dollar index is also very much a cheat code in how it can help you navigate when the stock markets, when risk assets, when crypto is going up and when it is going to reverse. Keep a very tight eye on this. What we're looking now for, if we want the bullish scenario in crypto and stocks, if we want that to melt up and continue pushing higher for the next 2, 3, maybe even 6 months, then we're looking for a complete breakdown here in the dollar index for that to continue lower, and then keep an eye on it. Once it bottoms, then the reversal process starts, and we probably get a massive crash and bear market in risk assets. If you found this helpful, make sure to hit the follow button, smash the like button, and I will see you in the next video.